Good afternoon and welcome to another VSA Capital Technology and Transitional Energy podcast with myself, Phil Smith, analyst, and joining me this week is David Scriven, our head of institutional sales. Andrew is away on holiday. So, David, how have you been faring during all this hot weather?
Very well, thank you very much indeed. And I'm just back from holiday, and for Mamma Mia fans, I went to Skopelos, but that's a discussion for another time.
Oh, excellent. Well, pleased to hear you've had a good break and you've come back from one hot place to another that's been very, very warm. And very apt for us to be talking about transitional energy and renewable energy. And I was watching during the week what was happening on the grid and generation, and particularly, on Monday and Tuesday when temperatures were peaking. And interesting to see that solar kind of power generation peaked at about 2.8 gigawatts. And to put things into perspective, today, obviously, it's a bit cooler. And there's 31.5 gigawatts being generated on the grid. Very little solar because it's cloudy. Wind is at 11%, nuclear 15%, and gas 54% of generation. So you can see how things vary there in terms of generation. And also the effect of grid stability. And we talked an awful lot about the theme of why we need energy storage technology to back up all these renewables on the grid because of the intermittency. And there's a quick report this week, not a quick report, but there was a big report this week from the National Grid, and it's called National Grid's Future Energy Scenarios Report. And they say that the UK will need to have 50 gigawatts of energy storage by 2050. And this includes pumped hydro, particularly batteries, which we talk a lot about in this podcast, and air-based compressed air solutions. And this is for balancing the grid, for short-term power supply, and very quick time power supply. And in terms of playing the space, we've mentioned some of the, obviously Invinity, our battery technology client we look after, but also some of the funds involved. JLEN, John Lane Environmental, that's JLEN, Gresham House, and Gore Street Energy, particularly on batteries. So there, really interesting report. If you get time to read it. Moving on quickly is Johnson Matthey. Ticker is JMAT, and it's 3.3 billion market cap. And Johnson Matthey, of course, produce catalyst technologies, and those catalysts are used in the automotive industry very widely, but also in chemical and energy industries, and particularly for hydrogen technology. And Johnson Matthey has said that they're going to build an £80 million gigafactory in Royston, the UK, to scale up hydrogen fuel cell components. So they've recently moved out of the battery space, David, and they're moving more into hydrogen, as we can see here. One of the companies we like is in the space is James Cropper. Ticker is CRPR. They're a specialist in technical fibers, where we're well known for making highly specialized papers, but they make fibers for aerospace components, but particularly they make fibers for gas diffusion layer membranes in fuel cells, and they supply 50% of the fuel cell industry. So there we are. So a bit more activity on hydrogen there, David. And then just quickly, the UK government has announced a program funding low carbon aerospace. And this is joint government industry funding. And some of the projects they're looking at there is advanced aerospace solar power, for instance. And then there's work being led by Yasa Motors, who we discussed before. And this is looking at high power and high torque electric motors. And they're going to provide, so there's £155 million for that and 106 million for other projects, in particularly hydrogen powered electric aircraft. So there. So quite a bit going on. We mentioned last week the US results that are all now coming out. Always helps give a wider picture of what's happening in the US markets, particularly in tech. And David, I know that you have been looking at some of the results that have been coming through.
I have indeed, sir. Now, a key difference from when we last did the podcast together is that the market technicals have now improved in the sense that we now have buy signals of the 50-day moving averages. For example, Amazon, Alphabet, and a large number of others, but also Netflix. And in Netflix's case, they lost less customers in part due to Stranger Things. And I'm kind of not surprised by that because my daughter and I are absolutely addicted to it. But we do note that the next series is not until 2024. Likewise, on the technicals, the SOX is behaving like that too, giving us a buy signal. Now, ASML reported yesterday and cut revenue guidance in the half for this year because of fast tracking shipping of its chip making machines led to a delay in sales recognition. But demand is still very robust, particularly in automotive. And there's still plenty of structural growth, I believe, in lithography. Phil, maybe you could make a little quick comment on TSMC if you wish.
Yeah, absolutely. But firstly, I mean, ASML is watched very closely by the silicon chip industry. They are a huge equipment provider to one of the critical steps in making chips, which is photolithography. And of course, one of the users of their equipment will be one of the world's largest chip makers, and that's Taiwan's TSMC, who do what's called foundry manufacturing. They're making chips for lots of different companies. And they, one of their bigger customers is Apple. And they came out with second quarter results showing revenue up 36.6% year on year to $18 billion. And what they said is, and we always look about what's happening in the end markets there because it gives us a feel for the economy's impact on demand. And they're saying that they're still seeing very high demand, high demanded for data centers in particular. So this is all of the cloud computing, but also for electric vehicles. And of course, what the market was really glued onto is like, what are they saying about their outlook? And they see their third quarter revenue up to 19.8 billion to 20.6 billion from just under $15 billion a year ago. So yeah, strong demand, very much continuing there, David. So, hopefully if this does continue, this trend continues, it starts to underpin share prices a little bit more going forward.
Yeah, I think I buy into that. No, very encouraging trends for the medium long term, I think. So if I can just make a couple of quick comments on Herald and Tesla and then hand back to you, I will do so. But I could just look at Herald because they came out with their half-year report. I don't want to go into all the details, but just highlight a few things that caught my eye, namely along the lines of their portfolio comments. One key thing was they're reducing their exposure to consumer-facing businesses because of their perception of the weakness in the consumer going ahead. And they highlighted that defense equipment was a bright spot. And they also highlighted that quite a number of bid approaches to companies in their portfolio have come from private equity. And a lot of these have been cash, interestingly, compared to shares, where that has been the case in, say, other downturns in technology markets. Now, Herald have got a lot of cash. If you include short-dated gilts, it's somewhere in the region of 114 million. So they're in a really robust position and can buy back shares in the fund. So I think they're cautiously optimistic and see buying opportunities. That's rather interesting, I think. And then in Tesla, they were up on good results. The Q2 beat, and they maintained production forecasts of 50% delivery growth target for the foreseeable future. Now, that means in the second half that they'd have to sell 835,000 cars. Now, also in the results, they managed to put through price increases, which helped somewhat in offsetting the challenges of the Chinese lockdown. And interestingly, they sold 75% of their Bitcoin investments in a crypto U-turn. So those are the quick things I wanted to mention. And maybe you would kindly like to chat about Dark Trace.
Yeah, I will. Just quickly before I get on to Dark Trace, Herald, of course, is one of our bigger UK-based technology funds, and yeah, very well widely followed as such and invested in. So Herald is always one that's well worth tracking and taking a closer look at, and particularly in what they say, as you said today, David. Yeah, moving on to news directly on companies this week in the UK in tech. Dark Trace, one that we've certainly mentioned before. The ticker is DARK. It's 2.5 billion market cap. it's one of our biggest cybersecurity companies, and of course that's very much an area that is receiving a lot of attention and investment at the moment for all sorts of reasons, including geopolitical and otherwise. So Darktrace, they're expecting their full year revenue to be at least $417 million, up 48% year on year. And the company has raised its revenue outlook 3 times in the last few months. Really strong and impressive growth. Also in focus for investors is the profit margins, and it's raised its full year profit margin forecast to 19.5%, and it's citing very steady consumer growth. So real good structural growth demand here in cybersecurity, and they're benefiting from this. And they've cited geopolitics and cyber attacks. They have also said that, given the growth, that they're expecting EBITDA margins of 15%, 17%. That's all good news. One new company. They've got customers including McLaren, Anheuser-Busch, the brewery group, among other clients. 7,400 customers now. Really, really impressive. So, good set of numbers there from Darktrace. That's in cybersecurity, very hot area, and another one is defense, as you've already mentioned. Kinetic, and this is spelt just so if you're looking it up as an investor, it's QINETIQ, and ticker is QQ. 2.2 billion market cap, and the shares in Kinetic, and this is one that Andrew and I were looking at defense a couple of months ago. This was one that we were looking at on our radar, and the shares are up 33% now over 6 months. And Kinetic is a real defense, technology business, and they focus on things like, for instance, robotics, and they're working there. We're completing production contract on robotic systems for the US Army. They're working on the Bradley electric vehicle. No, it's a hybrid electric vehicle, but the Bradley fighting vehicle, of course, is one of the. It's a very large US project, and they're working with the MOD, of course, and that's on equipment and so it's called the Engineering Delivery Partnership for Defence Equipment and Support, and they cited in terms of their trading that they've made a really good start to their fiscal 2023, and that their order intake has remained strong, and that their revenue and profit and cash are in line with expectations. So that's looking really, really interesting. So well done to Kinetic. Moving away from defence and getting back onto more onto the internet is Centralnik. Ticker is Scenic, 370 million market cap. And this is an interesting one. It's trading, so they've had interims. It's on, in terms of valuation, David, this is on the EV/NR multiple of 0.9 times, the PE of just 10 times. So it's low, yeah, exactly. Low rating. Low rating is Centralnik. What do? They provide, they're very well known for providing domain names to businesses. For supporting websites, they have email related technology, but this is all about brand protection and IP, of course, which domain names form part of that. So quickly, their interims, they reported sales revenues of $333 million, or $335 million. That was up 92%. From the prior period. So very strong growth, but I just need to, we're not looked in detail to see if there've been any acquisitions made during the period to support it. But this filtered through very nicely to profits, which is something that we look at. And their first half adjusted EBITDA was $38 million, and that was up 85%. Oh, here we go. Organic revenue growth was up 62%. Goodness gracious me, that is really, really good. And they closed the end of June with gross cash of $94 million, and their net debt was down to $65 million, and that was down 20%. So then something we love to see is that the board is confident the group will be at the upper end of market expectations. So yeah, super set of results there.
Absolutely, and I've recently seen another broker's valuations for this sector, and this looks stunningly cheap. relative.
Mm-hmm. So there we go. So yeah, definitely one to have a look at. Another one in terms of valuations that is looking very cheap, but we'll talk more a bit about this is Somero Enterprises. We've discussed this one before, David. Ticker is SOM. Market cap is 200 million. EV/NR multiple of 1.7 times and an EV/EBIT of just seven times. So this was mentioned in the Telegraph this week as well. They were highlighting results from Somero. What do? They are US based and they produce equipment, laser guided equipment that is used to lay concrete floors in big buildings. And particularly, if you think all that e-commerce that's going on, all those big hub sites being built, all got concrete floors. The ones that are operating with robotics running all over the place, they need very very level concrete floors, and their equipment helps to lay those concrete floors. So there's sell end equipment, and also they service their end equipment as well. And they have said in terms of their first half trading that North America is very strong, increasing from first half 21. And they've got backlogs extending well into 2023. That's very encouraging if they've got nice long order books. And they said that the European market was active during the first half of 22 on non-residential construction. So that's pretty good. But they did cite something, David. We look at supply chains, and they said that trading in Europe was down compared with the first half 21 due to logistics challenges and delayed shipping of machinery. But they're seeing catch up on those delays, so that's all recovering. And that results are likely to fall in line with market expectations. So a low valuation, bearing in mind there's exposure to the construction sector there, and always, during tougher economic times, there's sort of, questioning as to how that might perform because construction spend can come off. But at the same time, there's also in this structural growth in the growth in e-commerce and the expansion of hub sites. So yeah, maybe on a lower rating for reason of concerns over construction markets, but well worth looking at because there's structural growth, as I say, in things like big sheds and e-commerce related construction there. So it could well be a lower point to buy in at the shares.
And you get a divvy.
Well, there we go. Something that we very much like. And David, just to finally, I think, end on from me is One Spatial. The ticker for this is SPA. Market cap's 51 million. EV/NR is 1.7 times for low rating. EV/EBITDA of just 10 times. And these are low ratings here for this tech company. It's broadly held by institutions. What do? They produce software called location master data management software and solutions. This is all about what's in the ground, what's buried under the ground, where all the pipe work is, where rail infrastructure may be trackside, geographically where kit is located. And all of this is of great interest, particularly to telecommunications networks who do lots of digging up the ground, constructing their networks and planning them. And their software aids the construction, deployment, operation, and maintenance of telco networks. Using their this is a GIS platform, so it's satellite location related software. Anyway, the good news is they've announced a nice contract this week, and they've said that it's a 5-year contract with a major European aerospace company following competitive tender. This is for software licenses implementation. There'll be recurring revenues with that, and they're expecting 3 million euros over the 5-year period. So good bit of news there for One Spatial on a very interesting low rating, and one that we think is worth a further look at. And there we go. So I think it's interesting to see some nice positive news coming through. As always, David, we all take a lot of time looking for it so that we can deliver these podcasts. So I don't know, David, you got anything else to add this week?
No, I just think it just feels a little bit more positive than when we last spoke. I mean, last time it was quite tough, with everything going kind of down in one direction. But now, getting some, I feel a bit more positive, a bit more buoyed by some of the things we've chatted about, looking at the market.
Well, that's been a sunny week, and that is a lovely sunny note to end on. As always, we invite our listeners to write in with any ideas, anything we may have missed, or things you'd like us, obviously companies you'd like us to mention. And we look forward very much to chatting again with you all next week.
Thank you.
Bye bye, David.